Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor. I'm talking to you from New York City on this, the 13th day of April, 2021. I do like to remind you I'm the editor of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. We like to plug Chen Lin as well, his letter, What is Chen Buying, What is Chen Selling? In the mining sector as well, and primarily, I would say, the most value coming to you through the biotechs, which is an area that he's really specialized in and done very well for his subscribers. And Michael Oliver is with us today, too. It's olivermsa.com to follow up with Michael, who you'll be hearing from just in a moment or two. And I want to thank all of you for listening to the show, making it one of the more popular shows in the Voice America Business Channel. And send along any comments you have about the show to questionsfortaylor@gmail.com, questions, the number 4, taylor@gmail.com. And we do want to thank our sponsors for making this show economically viable. Today's sponsors, Noble Resources, Sitka Gold Corp., El Oro Resources, Irving Resources, Hannon Metals, Fury Gold Mines, Great Bear Resources, Lion One Metals, SK Mining, and Firefox Gold. I don't mention often enough that the sponsors in this show are invited to become sponsors only after I have chosen to cover them in my newsletter, Jay Taylor's Gold, Energy, and Tech Stocks. In other words, these companies are sponsors first and foremost, not because they make this show financially viable, but first and foremost because I think they have great potential to enhance the financial well-being of my subscribers and hopefully some of the listeners out there as well when they hear about these companies. In every case, I have purchased shares in these companies that sponsor this show. And I just thought I should let you know that these are vetted companies. They're not just companies that say, here, I have some money, give me some coverage. No, that's not the way it works. I should just mention here some of the highlights that recently, some of the things that have taken place with our sponsors. Great Bear Resources, for example, now the spinoff, the royalty company, is now tradable. It is trading in Canada and in the U.S., so if you happen to own Great Bear at the time of the spinoff, you now are the proud owner of Great Bear Royalty, which I think is going to be a huge success longer term. I'm planning to hold on to mine for a long time. Regarding SK Mining Corp., now that company put out a press release today stating that they have reviewed all the data from its 2020 exploration campaign and has conclusively identified multiple mineralized horizons on its 100% owned SK Precious Metals Rich Volcanogenic Massive Sulfide Project in the Golden Triangle of British Columbia. Now, this newly synthesized model of the seafloor mineralized system demonstrates that at least 6 stratigraphic units are prospective for precious metals rich VMS deposits across this 526 square kilometer property. And I will certainly be talking more about this in my newsletter, hopefully this weekend. Dr. John DeDecker, as the Vice President of Exploration, will be providing a discussion of this with a Toronto geological group at 4 o'clock today, and I hope to get some feedback from that on to my subscribers. Also just mentioned that El Oro Resources, which is on, I think, to a massive silver discovery in Bolivia, just put out an announcement today, 73.9 meters of 155 grams per ton silver equivalent. And Irving Resources, which I will be talking to Quentin Henning about very shortly in one of these shows, they just announced a strategic investment from Newmont Mining. They just put in $6 million to participate in that company's projects in Japan. So there's an awful lot going on. I'm really proud to have my current list of sponsors because I'm expecting some enormous wealth creation from many, if not most of them, in the weeks and months to come. And one of them also is Lion Mines, which you will hear about from Dr. Quentin Henning. He'll be on the show. We'll be talking to him about the Tuvalu alkaline project in just a few minutes from now. I've titled today's show, Living and Investing in a Dystopian Digital Currency World. David McElveny, Michael Oliver, and as I mentioned, Quentin Henning is joining me today. The handwriting is on the wall now for everyone to see. Freedom to spend your money as you wish without government permission seems about ready to end. At least that's the way it seems. That's because a mismanaged global monetary system now requires not only low interest rates, but negative interest rates perhaps to hold the system together. You may have heard of bail-ins. Well, after the 2008 financial crisis, they started talking about bailouts. Well, they had bailouts before. Now they're talking about bail-ins, which means that simply if the banks get into trouble, they'll take money from your checking account to help bail them out. So you are bailing them out. Bail-ins don't necessarily require a dramatic banking crisis like we had in 2008. A slower-moving crisis like the one unfolding now, right before our eyes, in which the U.S. will likely need to move to a negative rate of interest. At least that's what many believe. That may be in the cards, and if so, that means they'll be taking money out of your account, out of your checking account, which they can do legally, by the way, because when you put your money in the bank, you are basically providing an unsecured loan to that bank. Well, when you make loans and they're unsecured, tough nookies if you lose some money. That's the way it goes. To keep you from having that option, though, of course, now they're planning something different. To keep you in the banking system, they're not going to allow you to take out cash in the future. At least that seems to be what the planning, that there's that kind of planning in place if they need to employ it. The whole idea is you have to make sure that the banks are solvent. So keeping in mind that the bankers, they can do this. They have the legal rights to do this, and that's what the planners are expecting. In other words, what the elites are setting all of us up for is to deny our rights to the fruits of our labor and to our property. Sounds kind of Marxist to me, but anyway, that seems to be what's taking place, and we hope and pray that's not the case, but that seems to be the plans that they have for us. In the second half of today's show, I will be speaking to David McElvaney about his views on interest rates, the prospects for digital-only money, and how that might impact our investment decisions going forward. As I just mentioned, Dr. Quentin Henning will be with me in just a few minutes to give us an update on Lion One. But right now, I'm really happy to tell you that Michael Oliver is here with me once again. Thanks for joining me, Michael.
Hi, Jay. Good to be back.
It's always good to have you, and I just want to get your ideas on T-bonds and gold. You have been saying, and it seems to be playing out once again, that they are both safe havens, and when the stock market gets a little wobbly, the bond market gets stronger, money goes into that, or to gold. Gold and silver both are stronger today. Comments on that, and how long do you think that will continue?
Well, it's very clear that T-bonds and relative markets like TLT, the ETF of 20-year U.S. government debt, have trended down from a high in those markets in August, coincident with gold. So as rates have risen, gold has dropped, and during that same period of time, especially since late last summer, the stock market's been quite strong. They made their low in March, but they really got strong starting late summer last year. In fact, the NASDAQ 100 went ballistic during that time. Parabolic blow-off, we would call it. So, but what I'm looking at here is that technically speaking, the T-bond market, meaning as it drops in price, rises in yield, is coincident with gold and inverse. Both of them are inverse to the U.S. stock market for the time being. I think that the logic of higher interest rates, coincident with higher inflation, which makes sense, will in fact occur, but I don't think we're in it right now. I think that this is a trap. I think anybody who's getting short T-bonds now expecting higher interest rates because of higher inflation is premature. Technically, I can see the potential, and I think it's pretty strong, for a very sharp rebound in the T-bonds and TLT and so forth to the upside, meaning a drop in rates for several months. And I suspect strongly that if that occurs, the reason for it will not be inflation or interest rates, that kind of thing. It's simply a response of asset managers moving money into a safe haven as the stock market wobbles. I think the stock we cheered over the last week or two a new high in the stock market, especially the NASDAQ 100, which had made a high in September. I'm thinking of Amazon right now, which is a major component. But while the S&P's made new highs over the last few months, NASDAQ 100 and the leading stocks within the NASDAQ 100, names we all know, Microsoft, Apple, Amazon, did not. And so they lagged in performance noticeably to the broad stock market, which a lot of people have identified and noticed and commented on. So the leadership has waned. In fact, it's technically broken in terms of relative performance. But we needed, in certain of these markets, especially NASDAQ 100, I think, to go make a new high, and we've now done that. And now it may persist for another week or so, but we see vulnerability under the stock market, meaning after we've done this new cheering of a new high in the NASDAQ 100, that if it wobbles off very much at all, several percentage points in fact, you could start a domino effect to the downside again. In other words, that could be a very much a bull trap, meaning was the NASDAQ peak several months ago, it goes up and spikes out that high. If it doesn't sustain, and I don't think it will, and wobbles back down, then you'll really see the T-bond start to move upside. And I suspect during that same period of time, you're going to see gold moving upside. So large asset managers will be moving assets back into the two categories that they moved into late in 2019, early 2020, prior to the big drop in the stock market. So that's what I think is about to happen. Right now, T-bonds are rallying a bit today. In fact, they are where they were a month ago. So all the talk about rising rates, that really ceased about a month ago. And gold, of course, made a low in early March and tested it again in late March. We circled that low in early March and defined it as probably the low for the corrective process. And right now we're about 4.5% off that low and challenging overhead resistance levels, which I think we're going to break through. So anyway, watch the stock market because it's a variable that few people are thinking about on the downside. And think about this. If you're worried about the Fed reversing their monetary policy instead of being so dovish and worrying about inflation, if you hobble that stock market, they're not going to quit. You know, that's an asset category they will defend to the hilt.
Yeah, it would seem so, and certainly it seems like the lawmakers, the elites, are definitely in the stock market big time, and all hell would break loose if the powers that be don't try to defend it, I would think. And so Michael, how can this trillions and trillions and trillions of dollars of deficits be financed if at these low rates? They can't be. It has to come through money, I would think, money printing. If higher rates,
sure. No, they don't need a public to buy the stuff. No, there's no question about it.
No.
If the problem is tax collection, for example, if we find many non-filers this year relative to prior years simply because they can't pay, or delinquent filers, or insufficient filers who can't pay the full amount, et cetera, and that percentage number starts to get a little bit too high, they're going to have to start thinking about other sources of full revenue for the federal budget, and we know where that's going to come from. The Fed will simply buy the bonds. And so the government just issues them, the Fed will buy it, print the money, it's done. And, they don't need taxes.
But at some point, then the dollar becomes suspect. I mean, it has to.
Yes, and it's starting to cave again. We had a multi-month recovery bounce in the dollar, which everybody was impressed by. We were not. And it's, as far as we're concerned, that rally is now over. It's now breaking back down. And the dollar right now is in the 91s, dollar index I'm speaking of. If you get it back in the 89s again, kiss it goodbye. It's going to drop sharply at that point.
Real quickly, Michael, 30 seconds. What about Bitcoin? Yeah. Will Bitcoin benefit if the equity market starts to topple?
Well, our only concern about Bitcoin is that regulators will come in and do something to restrain it or control it or corral it, push it into a corner, because it's competitive with federal government control over interest rates, money supply. If you have a competing private currency that doesn't expand exponentially, then it's a potential threat to their control over money.
Absolutely.
And therefore, already Yellen and the ECB chair have both have used terms like criminal as regards Bitcoin.
Right.
So it's obviously an intent to regulate or control. So beware of that potential.
Absolutely. All right. Well, we have to leave it go
hobble the Bitcoin bubble. Yeah.
Absolutely. Yeah, absolutely. All right. Well, thank you, Michael. Thank you so much for being with us again. And we always grateful to have you. And we'll look forward to seeing you again in a couple of weeks from now.
Thanks, Jay.